went sideways. The small cap index is up about 1/3%, and the mid cap index should come up on your screen. It's down about 0.16 as well. So no great shakes. It's a quiet, grinding kind of start, at least on the indices. Let's see what's the picture like as far as the Nifty 50 heat map is concerned. How many up and down? And then we look at individual single stocks and how they are all starting. What do we have? HDFC Life on one end, Tech Mahindra, Kotak Bank, Hindalco, Bajaj Auto. Very few names in the red. So bulk of the Nifty stocks are higher, and the Nifty itself is down 25 points. Trent and Reliance, I think the fact that RIL is down as a heavyweight, perhaps adding to a bit of pressure at this point. But it's not much. I mean, it's just about 20 points, less than 20 points now. So coming up very, very fast, very, very quickly. But this is the first minute and a half we're talking about as far as market opening goes. Rima.
Well, let's just delve a little bit more in the Trent's price rate. Trent is now down 8% at opening, taking its one-year loss to 42%. The street does not like the moderation in growth. In Q3, top line went up 17%. In 9 months, FY26, the top line growth is about 18%, lower than the 20-25% that the company was signaling in terms of a long-term, medium-term kind of an earnings growth, and much lower than the 39% top-line growth that they clocked in the period of FY20 to FY25 when the company was a growth beast. So the street is punishing Trent, still down 7.5%. The other problem is Reliance Industries. Reliance Industries is down 2.5%, and HDFC Bank has lost close to about, 4% now, 4% plus in the past 2 days. Yesterday also it was down more than 2%, and it's seeing follow-through selling pressure. Tata Motors passenger vehicles December update in terms of sales didn't look good, and that stock is under pressure. Adani Ports has had a flat opening. They too came out with their update for the month of December. Well, the key takeaway is that container, which is the growth engine, is doing very well. That's up 8%. But the overall cargo growth is at 9% because bulk rail is seeing a bit of a sluggish growth. On the way up, it's the two banking names, particularly Axis Bank and ICICI Bank. Let's get the early rates up. Now it's settling. Kotak Mahindra Bank is up over 1%. Axis Bank has a gain of about 0.6%, but they're being supportive. Commodities are having a good start to the trading session. Hindalco is one of the top gainers today. It's hit a fresh 52-week high, 950 almost on Hindalco. Tata Steel opens up in the green. We should pull up SAIL as well, where the quarterly update looked pretty healthy. And HDFC Life, Apollo Hospital count as some of the other big movers. And ICICI Bank too. In fact, the entire private sector complex minus HDFC Bank is having a good start.
Well, that's right. Exactly a month ago, we here at CNBC-TV18 had put out this piece on aluminium stocks. And from there, some of the stocks that Rima mentioned, Vedanta, Hindalco, as well as Nalco, they're up between 18 to around 24%. So that's the kind of move that we've seen on aluminium. And the reason we covered aluminium was because, there are more number of stocks with exposure to aluminium. For copper, the sole player on copper is Hindustan Copper, and that one, in fact, is up close to around 2.5%. A few more stocks on the broader markets that are calling for attention. KSH International stock is moving up on massive volumes. They came out with their Q2 numbers yesterday, actually. That's the Q2 FY26. Revenues are up by close to around 50%. EBITDA is up, I think, by close to around 74%. And the EBITDA per ton has gone up by 40%. So KSH, that's one stock that's buzzing in trade. Another one is a stock that Sudarshan mentioned. Jefferies, they have initiated buy on MV Photovoltaic with a target price of 320 rupees. The street is taking note of that. That stock is well in focus today, reacting to the Jefferies note, MV Photovoltaic. So let's get that one up for you on the screen. Kandar Oil, well, that's a stock that was up, I think, 16-17% yesterday. It's building on the gains today as well. Stock is up another 6% as we speak. So big up move is what we're seeing out there. Cupid, well, that stock has bounced back now after a couple of days of drubbing. It's up close to 7%, one of the top volume movers in today's trading session. I'll tell you what, on the Nifty, if we have to see a recovery, two of the large weighted stocks will have to give their underperformance. We have Reliance Industries that's down close to around 3%. That's weighing on the index. And HDFC Bank for the second day running. So the Nifty, if it has to recover, then we'll have to see both these two cut off their losses, because put them together, that's more than 20% of the index that's down 2.5 to around 3%.
Even Dabur is down, 2.5%. It's reported they're expecting a mid-single-digit kind of a top-line growth in Q3. Rural demand is outperforming. Street doesn't like it because you're still not seeing a full-fledged, full-blown FMCG recovery despite all those GST revisions. So I thought they were okay, but the Street is hitting Dabur right now.
Well, I think, across it's basically slightly sideways, right? I mean, 60 points down, and we're now starting to settle in. So the cheer we are seeing around global markets in Asia, etc., and most global markets have had a pretty strong start to 26, which is a repeat of what we've had in 25. And here in India, we're kind of sort of repeating what we've done in 2025, which is not very much. So sideways, 26,200 with a 50-point dot cut. Market breadth is 1,100 up and about 1,300 lower. That's the NSE tally at this stage. I think the outsized pressure is coming from Reliance, which is down 3% this morning. So RIL header is, I think, largely the reason why we are seeing this pressure, which is come through. It's a stock which has basically started the year with high hopes. Almost, I think, did we get to all-time high in Reliance? So the high was about 1609. We made a new all-time high. We made a new all-time high yesterday. 1611, 1612 was a new all-time high in Reliance, and now we're turning down a little bit. So about 3 1/3% down on this one. Trent, of course, we've highlighted. Vari is another one. Swiggy is down 3%. CSB, but CSB, etc., had such a vertical rally, right? From 400 rupees to about almost 600 in 10 trading sessions. So that is understandable, a bit of a pullback. Premier Engines and more. Godfrey Phillips is down about 1.5%. Saman Capital is down 1.5%. KPI Green, Petronet Sonal was highlighting 1.5% lower. Devyani, where there's been news slow, 1.75% down as well. More down than up, certainly.
Even Merck Electronics, Nimesh was highlighting it in dealing room chatter, where there is a possibility of a management rejig. Yesterday, stock was locked in an upper circuit of about 10%, and today as well, lots of buying, stock up nearly 5-6%.
Yeah.
Merck Electronics, there you have it.
Yeah. Okay. Well, let's get in Venugopal Gare, who's with us. He's Managing Director, India Head of Research at Bernstein. Venu, good morning. Good to have you with us here. Wishing you, your team, your family a happy 2026.
Same to you, Prashant, and to the entire CNBC team.
You've the headline first, right? You've cut your view or rating, whatever you want to call it, in India by a notch. You're neutral, Venu.
Yeah,
it's a bit of a non-consensus view because for what it's worth, across the board, if you look at sell side, we've had upgrades, not downgrades, after the lackluster performance in 25, Venu. So your call in that sense stands out. So run us through, although if I look at the Nifty targets, etc., it's not as if others who upgraded the view are expecting a big year in 26. They're all expecting 10-12% kind of growth. I think your target gives us about an 8% upside. So that's the short preamble. I'd like you to explain, Venu, what led you to this downgrade.
Yeah, so it wasn't planned as a non-consensus view. Probably it just ended up happening like that. But I'll give you a very interesting context. 2024, I'll just bring you back 2 years back when everybody was positive on the market. I had started the year with a book profit call. And interestingly, I had an 8% Nifty return target of 23,500 that calendar year. And we all know what happened that year. Things started to peak off and materially correct in the second half of that calendar year, both from an earnings standpoint and a valuation standpoint. Interestingly, as we head into the previous year, 2025, my call was that macro has bottomed out in 2024 end, and macro is going to start to recover. Rates will start to get cut. We should be selective buy. And selective buy was largely with the view that SMIDs were still very costly. Heading into this year, the argument of moving to a neutral with a 8% return, which is similar to what it was 2 years back, and not a book profit call or a sell call, is simply because I guess things are slightly different at this juncture, where macro, while has peaked at around 8% GDP growth rate, is going to only fade out to a 6.5% growth over the next few quarters. So we're not really seeing any major macro collapse. Number two is earnings growth has been fairly meager in this financial year. It is expected to return, but I think a lot of that recovery in earnings growth is already priced in. More importantly, I do really believe that we are exhausting in terms of policy variables to drive growth. A lot of shift of the burden of economic growth has to shift to private sector, which may not yet be ready to handle that. Rates, there'll be some cuts, but not substantial enough. Government balance sheet is not like in a great situation for us to essentially drive growth through that. Fiscal deficit remains a concern. Putting all of this into picture, you essentially see a situation where there is positives around a bit in almost everything, but not substantial enough for us to believe that you should be able to make substantial outsized returns. And lastly, the main point is this, that even this 28,100 Nifty target 8% return was after factoring in 13.5% earnings CAGR over 2 years and using a 19x multiple on 2-year forward earnings. So by the way, that's not like, conservative at all. And yet you get a very modest return. So that was a challenge we were finding at this juncture to get returns.
So Street was banking on earnings growth to provide the fillip to the Indian markets to play catch up versus the rest. But clearly 13.5% earnings CAGR over the next 2 years is not going to help us give very strong returns. Wanted to get your view on real estate because you've upgraded real estate after the underperformance seen in 2025. Now, the question is from 2020, which were the post-COVID lows and bombed out, real estate gave exceptional returns from 2020 to 2024. And we've had only a 1-year period of correction last year where the Nifty Realty Index and stocks were down 15-20%. I mean, has it corrected enough? What is the call behind real estate?
Yeah, so I'll bring this to a very interesting situation. When you expect broadly high single digit or meager returns in India, it becomes very interesting in terms of how to essentially pick stocks. One of the key things that we saw last year, there was a separate report we wrote in terms of decoding 2025 performance, was the aspect of catch-up trades. So catch-up trades did meaningfully well, which is essentially stocks which didn't do well in 2024 but started to recover in 2025. And honestly, there wasn't an earnings growth anchor or an earnings revision anchor. These are just catch-up trades. Now, interestingly, when we saw last year, there were two sectors which were absolutely the worst performers, which was IT services and the second being real estate. So what we felt is this, that real estate broadly, if we were to just contextualize it, is usually when cycle starts, it lasts for 6-7 years. We saw a period of positive activity, and that's because it came after several years of a downturn. And you have a period of digestion. But when you look at earnings growth over the next 1-2 years, they are very different, or rather in a positive sense, still positive and a decent growth compared to what you would have probably seen during the phase of downturn. And you've essentially seen a major correction in terms of stock prices. There's the worst performers last year. Plus, the fact that these are also considered as interest rate sensitive sort of sectors. So as rates continue to moderate, we expect another 50 basis point rate cut this year as well. We think that probably this sector would see some degree of a lift. Remember one thing, that overarching return expectations are not very high for us across the board. So even in a positive return sector, we're not expecting a 30 or a 40% return. It will be better than the 8% Nifty returns.
Okay. All right. Hi, Venu. Good morning and good to see you, Ven. So you're guiding for returns on the Nifty for the next couple of years at around 7.5 to around 8% or thereabouts. And that's how we get to the target of around 28,000. Got that. The other, debatable issue is what's going to happen next and how soon are we going to get a deal with the United States? How big a positive catalyst will that be? And will that alter your view from this neutral stance?
Yeah, so we have factored India-US trade treaty to get signed this year and that too within the next few months based on whatever sound bites we've got. Fundamentally, the challenge that I sort of see at this is that it is a narrative or a positive narrative only for a few days than anything else, not more than that. And simply because what we've learned over the last 12 months is very simple, that unless you are, as a country, associated with a particular camp, which is US, I don't think this trade treaty can be believed to be sustainable. It can continue to change through the year. So that's a fundamental issue I have, that that this is going to be just a point trade treaty than anything else. Also remember from a relative perspective that the broader deal with China has continued all the way till November of this calendar year. So it's not that from a relative perspective, we're going to be primarily viewed as a country where FDI should improve or there'll be massive swath of manufacturing because India had identified as the next China plus one. I don't think all of that is going to happen. So this treaty is essentially going to lead to two things. One, a small up move in the market, currency to appreciate a bit, which is rupee, just a bit, when it happens. That's basically it. And the way I'm hedging primarily this particular event is through the ID services overweight trade.
Yeah, that's an interesting viewpoint, right? I mean, so we know what you're saying is you've got to be unambiguously, clearly in the US camp otherwise it's more transactional and it'll go up and down through the course of the year, even if this, some sort of an agreement takes place in the next couple of months.
Yeah, so I don't have to look. I would love to have this as a sustainable trade treaty, but I don't get the comfort today that 2 months down the line something changes. So that policy volatility has been a feature of the last 12 odd months.
Yeah. No, absolutely. Just a quick word, Venu. Lots of global thinkers are of the view that 25 was the year of AI infra kind of names, right? I mean, the actual the chip makers and the data center guys. I mean, physically and otherwise. And now it'll start to turn into, maybe it'll not happen this year, but next year, maybe it'll start this year. It's going to be AI adopters, cost optimization, etc. People are already starting to attribute, different percentages to, growth per se because of this. Cost ration. It's basically at the expense of labor costs. You think that will work out here in India? Have you thought about it? And which segments will benefit the most?
Prashant, the interesting thing is that we are way far behind at this juncture with respect to AI implementation across the board. If at all you're seeing AI implementations in a meaningful perspective, probably happening only in the technology world, which is tech companies adopting it first. Real world implementations are extremely meager. So what it means to me is that this is not a 12-month story or a 24-month story also in terms of being able to generate or eke out enough efficiencies for you to see margins improving or for you to see enough positives that can be deployed by companies to get volume growth. Not at all a story for the next 24 months. I think for India as well as globally, it's going to be a very slow adoption. A lot of adoption probably in 3 to 4 years will become meaningful. A part of that is also because technology itself and AI solutions itself haven't stabilized. So you need to see a situation where corporates are fully convinced that this is what we need to implement.
You don't think, financials, for example, financials is the area? I mean, at the end of the day, you need large data sets, right? And who is larger data sets than banks and financials generally? I remember having this conversation with the L&T Finance Management, and they spoke about AI quite a bit and how they've implemented it. You don't think that's a pack kind of sort of which comes up first? They've already adopted in many ways, but maybe it'll get done.
Yeah,
more.
I mean, we call it AI now. It used to be machine learning earlier. So this is just a change of a name than anything else.
One counter argument for a bullish view on IT is that increasingly companies are still spending a lot on hardware. Memory prices, for instance, now have gone through the roof. They've practically doubled. So basically, they're just crunching what would have otherwise maybe come to services, and that hardware spend by companies will continue. So again, just prolonging when discretionary spending for Indian IT services will make a comeback. But you've also downgraded, Venu, to you've downgraded consumer staples. Now, one part of the camp believed that with the interest rate cuts, the GST rationalization, the tax cuts, all this will flow through and benefit the consumer staples. Volume growth will slowly pick up. Rural was anyway doing okay-ish, but even urban will now show some signs of life. So explain to us the rationale behind the cut in the downgrade in consumer staples.
Yeah, so it's a very interesting theory I had. So I was a bit non-consensus when I upgraded consumer staples sometime in April or May of last calendar year, just ahead of the monsoon season. And broadly, it's about volume growth. It had nothing to do with GST because we didn't really know at that point of time that GST would get cut, but the idea was policy will be pro-consumer. Now, fundamentally, if I were to just think about it, the sector has done nothing much, through the year. Volume growths have, I guess, will inch up a bit, but not material enough for me to get excited. That's number one. So there will be an inch up in volume growth as you see the quarter or two pan by. But fundamentally, the challenge is that this year, when I look at the fundraising happening in, for example, the quick commerce sector, so Swiggy has raised money, and I think the third largest player is also filed a prospectus for raising money. So a lot of money flow will happen on quick commerce investments, which is not essentially that positive for incumbent consumer brands because it does create a pathway for smaller brands to also be visible in terms of presence. So this competitive angle as well sort of questions and worries me at this juncture. The other part is I don't know how rural and monsoons will shape up this year. Initial sound bites have been very mixed. So that's another concern today. So it's very hard to, take a proactive, positive view at the beginning of the year, especially when valuations are not cheap at all.
All right. Venu, one quick word. The RBI has turned pro-growth, right, for the last many policy meets that we've had, the commentary as well as, the cuts. How many cuts are you all penciling in for this year?
So for me, roughly 50 to 75 basis points depends on quantum of cuts, but whether it is 25 each. So that's the number that I have in mind. I guess it's going to be difficult to do anything meaningfully beyond this. Part of that is also to do with currency and how well you want to manage your currency.
All right. So 8% CAGR returns on the Nifty. The contra bets will be tech as well as real estate. And in the consumption pack, you prefer discretionary over staples.
So leave us with a slightly upbeat something here. This is like
I call in a very simple way that 8% return is a great return, number one. Number two is this is not...
That's not helping. That's not helping. 8%. Go on. Sorry, I'm joking. Go on. Finish the point.
So I have a lot of buy sectors still, right? Financials is a positive sector. Telecom is an overweight sector. Consumer tech is an overweight sector. And two more sectors, IT and real estate, have moved to a mild overweight. So, I mean, honestly, that's a good enough broader, aspect. The second positive, if at all, is the fact that the economy is not like in a very bad shape. Ignore the 8% context of where GDP is because it doesn't feel like a 8% GDP. But if you look at a lot of data points in the near term as well, things have been okay in the economy. Yeah. So we're not falling apart. Remember, this is very different from 2024. We are not collapsing in terms of macro or earnings. We're just in a stable situation. That's basically it. And remember, there's a lot of IPO and fundraising activity this year. Think of it in positive lens. Of course, it does impact valuations for the broader market, but you get a lot of new opportunities to invest in. So if you want to leave on a positive note, perhaps you get a lot more new stocks to assess and invest in this year.
That sounds like more work to me.
No, absolutely. But yeah, I mean, it's how you frame the question in your head. But, numbers, returns, we will track. And we'll invite you back, Venu, through the course of the year. This is the first conversation of 26, many more to follow. Venu, thank you very much for being here on CNBC-TV18. So that's Venu Gopal Garre of Bernstein with that perspective on markets. But we had HPCL yesterday with us, and we have Oil India today.
Indeed, Oil India is the next management on the show. The stock is down 8% in the last 1 year. In fact, the company had cut down the oil production guidance to 3.55 million tons versus 3.8 million tons in Q2. To discuss this, the impact on the U.S. action on Venezuela, we're now joined by Dr. Ranjit Rath, Chairman and Managing Director at Oil India. He's also the Chairman of the Numaligarh Refinery. Thank you very much. Happy New Year to you, your family, and the entire team. What we'd like to discuss with you is that will more crude supply come to the market post the U.S. action on Venezuela? Just get your thoughts in on what's happened geopolitically, the production targets for FY27, and finally, the crude pricing outlook. But Doctor, just beginning with, what's happened with respect to Venezuela, because you all have a very small, I believe, 3.5% stake in Carabobo project through your subsidiary. Do you all have dividends which are stuck? If yes, can you quantify what is the amount that it's been, stuck in sanctions? And if, indeed, this project now resumes with, U.S. taking over, what would be the new investments you will require? Would you be asked to pay up your share of capex?
Okay. First of all, thank you very much for this longest answer. I will break it into small pieces and then able to answer you. And yes, a happy new year to all of you in the studio and to all your viewers on behalf of Oil India Limited. The first question is the future outlook of crude. Can I take that first or the other one?
No, let's start with Venezuela and your presence there, exposure.
All right. So yes, we have a stake 3.5% in Carabobo field. The current investment exposure is about 60 million US dollar. And yes, one thing is for sure, while we will wait and watch the developments there, the production possibilities now looks better, and which is good for our investment terms. And should there be a requirement, we would like to enhance our investment because that's what is needed to enhance production from this excellent field that Venezuela is having. The prospects are good. So I am sure it will take some time to stabilize, to kickstart the production or to ramp up the production. So we will wait and watch. And should there be a need, yes, we will invest.
Okay. And when you say your exposure is $60 million in the Carabobo, is that the stock dividends?
No.
Or is the amount that you've invested so far?
Invested so far. Okay. What is required is we have to ramp up the production first. So the current production level is at very low. So we do foresee there is a good opportunity sitting there.
Okay. And are there any stock dividends? Because we understand some of the none. None for you.
Nothing pertains to Oil India Limited.
Got that.
Okay. All right. Hi, Doctor. Good morning and
morning.
Good to see you. Let's talk about the operational efficiency then. You drilled around 32 wells in the first half of the year, which is in line with the target. What is the target for the remainder of the year? And how much will you be able to do? Give us your guidance with regard to production targets, both on gas as well as on oil.
Okay. Excellent. I'm glad that you have started the question with drilling, which is closest to my heart. Slight corrections. As we speak, we have already completed 50 plus wells. Okay. And I should be able to explain you a bit. When we say drilling, the drilling component comprises of three parts. One is the rank exploration, which is currently going on in our exploration license fields, which includes our offshore exploration efforts, both in Kerala Konkan and in Andaman shallow water. As far as near field exploration is concerned, that's where we do exploration and exploratory drilling to resurrect or to kind of ensure accrual of additional oil as part of our reserve replacement ratio. As far as development drilling is concerned, that remains our focus in order to enhance our production. Therefore, these three buckets of drilling, this year our target is 80. And just to give you a perspective, 3 years ago, we were drilling about 30 to 35 number of total wells. This year, our target is 80. We will definitely cross 70, 75. That's for sure. Because as we speak, we have already completed 50 plus wells. Having done this kind of drilling, we are looking at two things. One, we should be able to maintain the production level. But before that, I must tell you, being part of mature fields that we operate on, we encounter a decline of pressure decline rather, which leads to production decline about 10 to 12%. So first is, as part of our reservoir management principle, we undertake very aggressive workover and development drilling, which leads to arrest of these production decline 10%. And on top of it, our guidance this year would be about 2 to 2.5% more. Last year, we did 6.71 million metric ton of oil and oil equivalent, which is both oil and gas included. Okay. Highest ever. And this year also, we aim to surpass that number.
Okay. All right. And to split it up, sir, earlier you were talking about oil production, I think 3.55. And gas, I think it was around 3.6. So ballpark, that should be the guidance, right?
That will be the guidance.
Okay.
The best part is we are also looking at cost optimization, which you touched subtly as part of our efforts to enhance a kind of financial prudence.
Okay. All right. Doctor, just one more point I wanted to ask you with regard to the Numaligarh refinery expansion, the timelines, the expected distillate yield. What is the capex that it's been made? How much more is expected? And how is the ramp up expected on this particular refinery?
Okay, good. I've got a good news to share. This is already a public information. As far as the commissioning of the 9 million ton capacity expansion is concerned, we have kick-started the commissioning on 31st December as promised.
Yes.
That means the mother unit, that is the crude distillation unit, we are already having crude in. Now, as you would appreciate, the entire process of commissioning of all the units will take about 6 to 9 months, and then another 1 quarter or so for stabilization. As far as capex is concerned, we are looking at a total capex of about 40,000 crore, which includes the refinery, 9 million ton complete, the Paradip Numaligarh crude oil pipeline, 1640 kilometer, 1635 kilometer complete, a polypropylene unit, 360 KTPA, juxtaposed to the current refinery expansion complete. So that is the bouquet of investment we are looking at.
Okay. Got that. Dr. Rao, that's very helpful. Good morning, sir. Happy 2026 to you, your team. Prashant here.
Yes, Prashant.
It's fascinating stuff, what you're describing to us. But, we're talking about oil, and you would agree with me, the last 1 year has been about geopolitics and oil, and both are kind of linked at the hip. So can't get away too much. So, my colleague Rima asked you about Venezuela. Let me turn your attention towards the other hotspot, which is, of course, Russia. Has Oil India been able to repatriate some of the stuck dividends from your joint ventures in Russia? Some $300 million in dividends were stuck. Has that come in?
So I'll give you a perspective. As oil and gas operators, we are well prepared for geopolitics. That becomes one of our building blocks of decision making. As far as investments in Russia is concerned, we have got 2 investments. One is Taas Uriak and the other one is Vanker. As far as Taas Uriak is concerned, we have already got 100% dividend out of our investment. Now it's on a self-actualization mode. Vanker, it's about 90% of dividend we have already received. Now, what is struck is the money which we have received, but it is in our account of SBI CIBIL. So we are not worried at all in terms of the value of the money which is there, because it is with us. It's only a matter of time. We will figure out how to get this money and then ploy it back in some other overseas investments. So we are not worried at all.
Yeah. So this is an SBI account, your SBI account in Russia.
Yes.
And it's stuck because of capital controls, SWIFT-related restrictions, etc.
That's okay.
Okay. But it's been about a year now, right? That this is
fine. As far as our capex requirement is concerned for our exploration and development purpose, this money doesn't come to our play. But yes, once we get a clarity on the transaction issues, we will definitely utilize this money for our overseas investment purpose.
Yeah. So the 2 assets that you mentioned, right?
Yes.
Vankoneft and Taas Uriak. So you own stakes in these assets along with other Indian oil companies.
Correct.
Are you divesting these stakes, sir? Because
no, nothing of that sort right now. It's an India Inc. which is invested, so we don't foresee any divestment as we speak.
Okay. There's no pressure. You've not got any.
No, absolutely
ministry,
not.
Nothing at all. Okay.
Absolutely not.
Are these assets linked to? At the other part, on the other side, your partners are Rosneft, etc.
Yes.
The reason I'm asking you that, sir, is that the US, I think this was a couple of months back, designated Rosneft and I think one more entity as a specially designated entity, right? I mean,
yeah, absolutely.
Which means anyone doing business with those entities or subsidiaries of those entities can also be sanctioned. So there is that risk.
Absolutely, absolutely. There is absolute clarity with us. There is no sanction on our operations.
Okay. But that risk, has it been, have you discussed it internally, or, I mean, it's something...
Prashant, I told you, when we go to overseas asset acquisitions, we are well prepared. It's more important that are we prepared, are we aware of the risks that we are going to encounter? So as long as you are prepared, that I don't foresee there is any problem.
Okay, all right. Fair enough. So no plans at all to divest out of these assets. I think, so IOC, Oil India, BPCL jointly hold 24% in one asset and about 30% in the other asset. In that sense, and you're holding on. And that money is in your account, the dividends, and at some point when these restrictions go away, you'll be able to use it.
Absolutely.
Got that. Just leave us, Dr. Rath, with some perspective on, what will be the production increase that we should expect in FY27, FY28 from Oil India, sir?
See, there are two ways of being an oil operator. I would answer your question in two parts. One, given the fact that we are on an active and aggressive exploration, purpose-driven activity now, should there be a discovery, then it's a different. The production enhancement is concerned from our mining lease areas. We do foresee that we will enhance our production. Last year, we did 6.71. This year, we will surpass that. While two parts to that production effort, we will definitely arrest the decline, which we have been successfully doing in last 3 years. So that will be one piece of our effort. The second part is, by virtue of next year, our plan is to drill 100 wells. And we have already created an inventory of 200 plus wells for our next 3 years target. So when you drill as many wells as 80 and 100,
you increase your chances. Yeah.
You are bound to get more production. And the Assam Self, there, the place where we are operating, is still have about 30 to 35% of yet to find resources.
Got it.
We are absolutely pretty comfortable as far as our production outlook is concerned.
So just to wrap this interview, and I want to go back to one point about the Numaligarh refinery, and congratulations on the commissioning. So in FY27, what is the expected utilization of the entire expanded capacity, and what can it add to your bottom line? What is the expectation on margins?
Okay. So as far as Numaligarh refinery is concerned, all of you know, last 2 years or so, we have been having 100+% of utilization.
Correct.
This year also, we will be definitely going to have 100% plus capacity utilization. The distillate yield will continue to be 87% plus. The refinery, we will definitely have a good margin. As far as 2027 is concerned, we will not be able to have the full utilization of 9 million ton. That's the process requirement, because first 6 months...
So 40-50%? Is that a fair assumption for the full 9 million tons?
I would look at a number of 40 to 50% capacity utilization, but let's wait for that stabilization process. Because when you migrate from a 3 million ton refinery to 6 million plus to 9 million, 2 trains, and you have to run a crude oil pipeline of 1640. So we would wait. But yes, it's a fair assumption of 40 to 50% capacity utilization.
All right. Dr. Rath, we'll leave it there. Thank you very much. Our first conversation of 2026. I hope we can make it a regular feature through the course of the year to get updates from you, sir. Thank you very much.
Very much. Thank you very much.
Okay. We'll take a quick break here. We are back. We focus on the cement sector. Pulkit Patni of Goldman Sachs on the other side. Stay tuned.
Welcome back. Let's focus on the cement sector then ahead of its Q3 earnings season. Goldman Sachs expects the Q3 demand to pick up after a subdued showing in the first half of the fiscal. They remain skeptical though on price hikes due to the capacity coming on stream. To discuss this and more, we have Mr. Pulkit Patni, the India Industrials Analyst at Goldman Sachs, who joins us on the show. Hi Pulkit, good morning and good to see you, Ben. Well, I was going through your note and you're sounding a little bit more optimistic on the volumes front, at least for Q3. That said, getting into Q4, what kind of assumptions you're making, both on the volume parameter front, because there will be that risk, right, of the year-end phenomena of pushing through volumes that will actually weigh on pricing. So your expectations on both volumes and cement prices from here on.
So, good morning and thank you for having me. I'll rephrase that a little bit. What we are expecting for the industry is to look at a weak third quarter from a profitability perspective. From a volume perspective, we've been actually positively surprised that what started off as a weak October picked up at the margin in November, and December volumes have turned out to be really strong. So I would expect that momentum to actually continue all the way till the end of the fourth quarter. So we are pretty optimistic that volume from here on should pick up. The other piece that we've touched upon is that we've seen early signs of some attempts of price increases, and we do think that at the early part of fourth quarter, which is now, anytime, we expect price increases to be attempted. To the point that you made, absolutely, towards the end of the fourth quarter, given that everybody pushes volume, we do expect some bit of impact on pricing to be negative. Net, we expect a weak third quarter because of prices and a much better fourth quarter supported by both slightly better prices as well as better volumes.
All right, Pulkit got that. Pulkit, in the next couple of years, the EBITDA estimate that you're working with for the industry is expected to improve by around 200-250 rupees per ton. So what are the assumptions you're making both on pricing, volume, and I think input cost or the measures that have been taking where various companies will help in cost saving? So how do you see this 200-250 rupee EBITDA per ton for the industry increase?
Sure. First of all, FY26, we have a pretty favorable base, right? This has not been the best of the year for the cement sector overall, whether it comes to pricing and even volume in the first half of the year. So you're working with a profitability number that's actually itself subdued. Now, when we look at the next couple of years, I'll break it down into two parts. The first part is the first part of the next 2 years, which is the next sort of 6 to 9 months. We do expect a lot of capacity to get added, which will have some negative impact on pricing. And to that extent, we do expect the first half of next year to see some subdued prices. Having said that, I think the bigger picture in cement remains intact, which is one, we expect demand to hover around the 7 to 8% range CAGR over the next couple of years. Secondly, we've spoken about this earlier, but cement is becoming a big boys club where the larger players are all working towards the cost, which is whether it is converting their power supply to more green power, more waste heat recovery systems, whether it is them working on logistics, converting road to rail, etc., and the overall operating leverage that is going to come because of the size and scale. For the industry, and especially the large players, to get to about 200 rupees EBITDA per ton improvement from here on is something that we think should be relatively easy. What will support in the process is consolidation, and that, I think, is going to be the additional lever for profitability improvement in the cement sector.
Do you think bulk of consolidation, though, is behind us? I think the top 4-5 players from ballpark around 50-51%, I think they moved to around 65%, early 60%. Bulk of the consolidation, though, is behind us?
Yes, the last 4 years have seen significant consolidation. We could still see more players coming in because ultimately it's cause and action, right? If you see cement companies not taking profitability or adding a lot of supply in the near term, there will be some small players who will feel the heat of profitability and there could be more coming in. Plus, I think what we have to fully appreciate is that the larger you are, the benefit of scale, size, cost come to you, and which over time will make the smaller players a lot more inefficient, in which case I would say maybe not the same scale, but you'll see consolidation as a theme may continue in this sector for a slightly longer period.
And what's the last accounted number when you talk about the big players holding most of the market?
we'll say we'll probably get to, as an industry, we can get to about close to 65 to 70% just with the larger players.
The top 5 players.
Yes.
How do the return ratios change now, in this sort of a scenario in terms of when pricing is a little bit weakish, though volume push is coming about? When normally you put up a cement capacity, I think the matrix was ROC should be early teens. That number could have dipped a little bit, right? So how has that changed of late?
In a cyclical business, you'll always have periods where when companies are buying capacities, their capital employed goes up and it takes time for them to improve efficiencies in the acquired capacities. The good news in the sector is that cost of acquisition has gone down from $140, $150 per ton to more like $100, and greenfield capacity expansions are happening anywhere between $60 to $70 a ton. So I would say while ROCs have been subdued in the cement sector for the last few years, we do expect with consolidation, those ROCs should actually start inching up. And somewhere, because the valuation in the sector, while it's corrected, it's still at the higher end of the range, is because market does expect consolidation to bring in better return ratios for the cement players as well. So we would expect, and we do have that in our numbers, that ROCs should trend up as utilizations improve over time.
All right. And geographic preference between the north as well as the south. The last many years, north has been doing much better. But now you have new players that are going out there. The capacity addition as well will be fairly high, while the south has been hovering around lower capacity utilization levels. So what is the preference geographically?
Absolutely. This is something that we have touched upon in our report as well. Yes, that north has been historically one of the best regions to be in. But given that bulk of the capacity addition coming from the large players, including entry by a few smaller players, is all happening in North India, we are looking at almost about 22 million tons of capacity getting just added in North India over the next sort of 18 months, which is why our preference would be for South and West. West as a region seems fairly strong, not much capacity coming in. Demand drivers, particularly real estate in cities like Mumbai, will be strong drivers. So yes, we do believe that North will see capacity utilizations dip down by about 600 basis points, and which could have impact on profitability.
Okay, all right. Final couple of questions then. The long-awaited merger was announced in the Adani Group between both those two entities, though they were almost operating as one. So the synergy benefits could be limited, though the management claims otherwise. Do you believe that this is a big kicker, or this would help them work as one, and ACC, Ambuja, Sanghi, Orient, all of them coming together?
Nigel, while we don't comment on individual stocks, the point that I made that consolidation in the sector will continue, and consolidation comes with its own benefits in terms of, using limestone one versus the other. There are other benefits of brand exchange, etc. So that, I think, as a theme will continue, but I'd not be able to comment on company-specific situation.
Okay, and you would rather stick to the biggest cement player, going by your note, right? The big daddy, Ultratech Cement. People thought that the new challengers are coming in there, but the big daddy is your top pick.
Yes, Ultratech is our top pick in the space.
It's been good speaking to you, Pulkit. Thanks a lot for joining in. You've given us a fair idea with regard to how do you see demand, supply, as well as volume trends that will pan out. Appreciate you joining in. Look forward to chatting with you as 2026 does progress.
Thank you for having me.
Well, time to slip into a short break. On the other side, Manisha Gupta will turn the spotlight on the commodity sector. Stay tuned.
Welcome back. It's a flat market that we have on our hands. Nifty Bank, though, is doing better. The Nifty Bank is up 200 points, led by strength in ICICI Bank, Axis and Kotak too, managing to show some gain. Chandan Taparia, Motilal Oswal Financial Services is now joining in to give us some 10 a.m. technical calls. Chandan?
Yeah, good morning, Rima. Thanks for having me. So to start with Nifty, it has been holding the support. So till it holds above 26,100, overall bullish stance could continue, which can take it towards 26,500. Talking about Bank Nifty, declines are being bought with support of 59,750. We are looking for 60,750 to 61,000 marks. Now, looking at the stock ideas, first it is buy on MCX. Major trend of the counter is positive. Longs are intact. Rollovers were better and all set for a consolidation breakout. So one can buy with support of 2210 for an upside target towards 2350. Second trading idea, that is buy on Chola Finance. Most of the financial counters are doing well, and Chola Finance has seen a role reversal. A strong recovery was seen from 1550 and now giving a fresh breakout. So one can buy with support of 1780 for upside target towards 1900. One more trading idea, that is buy on BDL from Defense Pack. It has bottomed out, negated lower top, lower bottom. So we are recommending to buy with support of 1535, and here target is 1620 marks.
Okay, all right. Those are trades, Chandan. Thank you very much. Good speaking with you, and we'll talk again. Well, let's talk about commodity markets. Manisha is here with what's top of mind. It's all buzzing, especially base metals, precious metals. Manisha, what are we talking about?
Oh, base metals, absolutely, because that's an area that continues to buzz and very, very strongly. And we're looking at multi-year highs, record highs in many of these commodities. This is what we've done in the overnight markets. And as you can see, it has been a phenomenal move there coming in there. So platinum gained up by 6.5%. Silver was up more than 5%. Copper, record highs, 5% of gains coming in there. And gold prices gained up 2.5% as well. This is what we've done in this year till far. And as you can see, it has been a very bullish, strong start to many of these metal prices therein. So anywhere between 5 to 10% of gains in 2026 so far is what we've done in sense of commodities. Let me remind you that all of these commodities in last 1 year have given you tremendous returns. Platinum has returned 136% on your investment. Silver has gained up by 155%. It has been more than 45% of gains coming in for copper, and gold has gained nearly 70% in last 12 months as well. So strong gains continuing, while it has been about fund buying, fund allocation, and of course tangible commodities doing quite well, speculative bullishness as well. But many of these commodities also have individual fundamentals working for themselves. For copper, we are trading at all-time highs because there is concerns over potential U.S. tariffs that could come in the first quarter of 2026 itself. Apart from that, it also is about strike in Chile's Manto Verde mine, as union members are seeking larger share of profits, with copper prices trading at all-time highs, gaining 45% in last year. This is something that you would perhaps see in various mines where they would want a share of profit with the prices running where they are. Take a look at aluminum then, and the LME prices are trading at a 3-year highs. We're looking at China set to breach 45 million tons of a cap that they had put in 2026. So that tells you that the China production will continue to be curbed. Apart from that, it also is about Indonesia facing higher energy costs, local regulation risk. That is something that has been supportive. We've been talking about lower availability of bauxite, lower ore grades as well. That has been supportive for aluminum. And in any case, you have been looking at key smelters facing issues in various countries like Iceland, Mozambique, Australia, etc., supporting aluminum prices, so much so that investors and bankers have been telling us that number 1 is copper, number 2, absolutely aluminum in your portfolio as a place there. Take a look at the nickel prices. Well, they have been underperformers, but we're looking at prices at a 1-year highs for this one as well. This is after Indonesia has proposed a 34% reduction in output in their 2026 budget. So that means lower nickel or lesser nickel availability going forward for this year. Iron ore, which ended 2025 on a weaker note, has started 2026 on a positive note therein. Overnight has been 2% gains, and the markets believe that China's steelmakers are restocking ahead of the Lunar New Year holidays in the month of Feb, supporting prices. Zinc should come in on your screens because that one is trading at a 14-month highs. The global inventories are the major reason here, which are at under 2 days of global consumption. even as we have seen the inventories increase, they're not really much when you look at the demand in front of that. So on December 1st, the inventories were at 52,000 tons. On 2nd of Jan, in a month later, we're looking at 100,000 tons. Even as they have doubled, 104% of an increase there, still at a 2-day of global consumption there. Finally, silver should come in on your screen. 5% of gains in the overnight market, and we're looking at heightening geopolitical tensions, China export restrictions, and then China, remember, produces 60 to 70% of all global refined silver. So whichever way you look at, individual fundamentals, macros, all of that has been quite supportive for precious metals and base metals.
All right, Manisha, thanks very much for that. Absolutely. Starting 26 on a strong note after a super 25. Well, we'll take a break. Lata will connect with Sunil Singhania, founder and a fund manager at Abacus, on what to expect from markets in 2026. That's a conversation you don't want to miss, coming up in just a bit.
Here's wishing all of you a very happy new year. Well, my new year is starting a little late because of a longer holiday. So my new year pledge was that in my first show, I will get you the best of all investors, one of the most intelligent investors in India. And fortunately, he obliged. May I welcome Sunil Singhania, founder and fund manager of Abacus Asset Management. Sunil, thank you very much indeed for obliging, and a very, very happy...
For very flattering words, and Happy New Year to you, all your colleagues and all the viewers of CNBC-TV18. Have a great 26.
Thank you. Thank you very much, Sunil. Every word was well deserved. Well, let me get to the matter at hand. You know, 2025 was a bit of a disappointment for us. 10% returns is not bad, but we underperformed practically all the major DMs and EMs we compare ourselves with. What's the outlook for 2026? Our poll, let me just tell you, a majority of the participants, about 55%, see a 10 to 20% return, basically over 10% returns. Your take?
I think you're right. 25 was a modest year, and as human beings, we always want to have more, and we always keep on comparing ourselves with the markets which have given the best returns or the asset classes which have given the best returns. But we also have to take into account, Lata, the fact that between 2020 and 24, I think we outperformed by a big margin. In fact, whoever was positive between 20 and 24 ended up having the best 4-year block of returns ever. So, that was the context. I think as we head into 26, there is a little bit higher optimism. Obviously, the economy is starting to get back on its feet. Interest rates have been cut. There is enough liquidity in the system. Balance sheets of corporates are pretty decent. And corporate profit growth, which had fallen to only 3-4% last September of 24, is now come back to 10%. And hopefully it should trend up towards the 14-15%, which is the long-term trend of profit growth, which we see in India. There are a few headwinds. I think the biggest of all is the tariff thing. And I think that keeps on playing, in our heads always. So I think 26 is going to be a very interesting year. We are optimistic. At the same time, given the fact that we continue to be, I would say just above fair value in terms of the multiples, I think I would agree that we are going to have like a low to mid-teen kind of returns from equities in 26. But more importantly, I think it's going to be a year where one has to make less mistakes because, the lure of momentum is so high. Everyone wants to, buy into stocks which are moving in terms of prices, not necessarily fundamentals. And therefore, at least from our perspective, we are very clear that this is not the year where you can afford to make too many mistakes.
Okay, then, I had other questions on fundamentals, but let me come to that you're raising. What are the avoids sectors? What are the momentum mistakes?
I would not say avoid sectors, but, by nature, Lata, we are very clear that when you invest in equities, you become partners in the business. And we would like to become partners in a business where what you pay today will be more than repaid back to you by way of future profitability. We are not saying that everything which is new age or new economy is bad, but, I think there also one will have to distinguish. And we are very clear that we would want to give capital to companies which will use that to grow, not to burn. And therefore, perennially loss-making or cash flow burning companies are something which we should avoid. The other thing is it is very difficult to value these companies. And, more often than not, one gets sucked into a momentum kind of a thing. So I think that is where I would say that we have to basically be a little bit careful. Obviously, there are some sectors where we have a slightly, I think, defensive view, IT services being one of them. We continue to believe that the days of 10-15% growth rates are behind us. And on top of it, we are also looking at a lot of disruptions, the visa issue being one, tariff, the US being the other, AI-related disruptions being the third. Obviously, the tailwind in terms of currency or rupee depreciating has helped them a little bit. But I think that is, again, one sector where we will be slightly more defensive. But I would say that generally avoid companies where prices are moving up, not necessarily because of fundamentals, but because of a lot of FOMO into them.
Yes, I take your point on that. But, this IPO frenzy, that's where I guess a lot of disappointment has come with a record number of IPOs not getting back even to their offer price. And we're going to have a bunch of IPOs coming in as well. I think Zepto, Oyo, Boat, all of them have lined up with DRHPs. What is your advice? Is IPO the wrong way to start investing? Generally avoid IPOs because everything is known about them. There's no alpha over there.
I won't agree, Lata. I think in a growing economy, and I always go back, when we grew from $0 to $1 trillion in terms of economy, that was contributed maybe jute and cotton and, textiles and some utilities, some steel. 1 trillion to 4 trillion, the path in terms of the economy, I think the contribution came from private sector banks, IT services, pharma, a lot of consumption-oriented sectors. And it is very clear that when we move from 4 to 8 trillion, I think a lot of these new age businesses will contribute a lot to that journey of 4 trillion to 8 trillion. So you can't write them off. And typically to invest in these companies, I think they necessarily will have to invest on the listed side through the IPO route or once they get listed. So you can't write off everything. But at the same time, on the listed space, the temperament, the philosophy, I would say the volatility bearing capacity of investors is very different from the private equity side.
Yes.
And therefore, one has to be very clear what you're betting on. And it's not like a short-term roulette which you're playing, but companies where you believe they're going to sustain and survive for the next 5-10 years. I think on the digital side, the new age businesses which you referred to mostly, winners take all. So, you have to find companies which will survive, and the companies which survive for 5-7 years, obviously they will create value. The other thing obviously is the valuation. It's very difficult to value because these are not traditional businesses. So the valuation is all about, demand and supply, what the investors are willing to pay for when the IPOs come. So we are looking at them, but we are very, very, very selective.
Mm-hmm. No, I take your point. I mean, I was not going against the digital companies. I'm only saying that at IPO, they come at valuations which seem to have everything in the price. And I take your point. I mean, Grow has done very well. And therefore, this network or winner-take-all effect is something, for which we have to pay a price. But Sunil, if you are willing to speak about stocks, that would be most welcome. But what sectors, since you normally shy away, will pharma has been one of your favorite sectors, if I remember right, you have. Will that continue to perform? Because some of them did very well in 2025.
So no, we were positive on 3 sectors and we continue to be positive. 2 of them have worked out well. So all kinds of financials, including some NBFCs, non-fund-based financials, predominantly asset wealth management companies, insurance companies, I think they have done very well. Banks also have been doing reasonably well. Growth rate obviously have slowed down to maybe, low double digits, but very good asset quality. Metals have done phenomenally well for us. And to some extent, we were lucky because it got helped by what is happening globally in terms of metal prices.
Yep.
Pharma is one sector where we are positive, which has not worked out in the way we would have liked to. But I think there is a lot of more there, both domestic pharma, global pharma. I think there's a little bit of overhang of any negative news which can come in from the US front. But Indian pharma has a lot of moat. So I think pharma is one sector where we would like to stick our necks out and be a little bit more overweight. I think engineering also has not done well after a phenomenal 2-3 years. 25 has been a year of I would say normalization. Stocks had moved up significantly beyond fair value. They have corrected quite a bit. And rightly so, because one, valuations were very high, and second is the growth which the street was expecting did not come true, largely also because a little bit of slowdown in Indian economy is also the fact that because of tariffs, exports also got hit. But I think specialized engineering particularly has a lot of legs, and that is again one sector where one has to keep an eye on. And that would also include opportunities which come from the domestic side, which would include, the defense, railway, and so on, and also on the export side.
Yeah, precision engineering clearly has done very well. Sunil, what about commodities? I mean, that seems to be a herd trade now, but you think it has legs?
So one good thing about commodity companies in India, particularly metals, is that the companies' balance sheets are phenomenal. It's not the kind which we used to see 10, 20 years back when one bad cycle used to take these companies into losses.
Yep.
I think the bounty which they reaped between 20 and 23 helped them clean their balance sheets. Their debt equity is well under control. They have become one of the lowest cost producers across, in the world.
Are you including ferrous? Are you including steel when you say metals?
Yes, steel is slightly lagging behind non-ferrous, but there also I think the government is ensuring that the steel industry in India survives, because if you just allow imports to come in from China, India will stop manufacturing steel. So I think rightly so there has been support from the government and which has helped them. Obviously, non-ferrous companies are doing much better because of the spurt which we have seen in the price of aluminium and copper and now nickel and zinc and so on and so forth. But ferrous is also pretty stable. Obviously, non-ferrous has had a great last 3-4 months. They continue to look good. However, these are deep cyclicals. And at least from our side, we try to restrict the weightage of deep cyclical companies to like less than 10% in the portfolio.
Okay, fair enough. Well, a final question, because I'm running out of time. What should we be worried about? I mean, this Venezuela event has absolutely shaken us and looks like geopolitics will dominate. Can that have a very negative impact on markets at all? How do you parse? And more broadly, what are the risks to markets?
Well, Lata, very funnily, people were very worried about interest rates hike in Japan. And when the interest rates were hiked in Japan, Japan went up the highest.
Yes.
And yesterday, Venezuela markets went up by 17%. I think so. These kind of geopolitical events, now we have to live with it. We are in a world where there are very strong personalities governing most of the countries. It's a period of not laymen, but he-men. I'm very sorry, a little bit more this thing. But, and these events are going to continue. I think from India's perspective, what we have to watch out for, we can't afford this tariff thing to get out of hand. We need a resolution because all said and done, US is the largest economy in the world. And we do export almost $100 billion worth to US. So I think that is something which we need to watch out for.
Oh, yes, we have to play our cards very, very carefully. It's a dangerous world out there now. Thank you very much, Sunil Singhania, for lighting up the start of our new year with your advice to investors. Thank you very much for joining us. Have a great 2026.
2026 again. Thank you.
Okay, so that's some wise words coming in, sectors that you should watch out for, and the hope that this mid-teen earnings and market returns is likely to be our lot in 2026. That's a very big wish. We can live with it. We wrap up on Bazaar on that note. Chartbusters coming up.